How to lower your taxes using real estate. This is a big hack. Many people are trying to invest in real estate right now and wondering, how do I invest and lower my taxes? Well, first off, you have to understand that real estate is a form of investment. I think it's one of the best forms of investment because if you invest in real estate, not only are you feeling the power of investing, but you're also getting an asset. And real estate is a form of investing that can benefit you on your taxes every single year. Now, there are some limitations and restrictions which we're going to talk about in this video, but I want you to know that real estate is a strategy for you. No matter if you're a business owner, no matter if you're a W-2 wage earner, if you have a job, these are things that don't matter if you're a real estate investor and you really want to take advantage of the tax code. Let's use an example. You buy a home that you want to rent for $250,000, right? And so you rent that house. Let's say you rent that house for $8,000 a month. For simple math. You're getting it over the course of 12 months, that's $12,000, right? So you have $12,000. Now, we all know if you own a house, you probably have to pay two things that are guaranteed no matter what, right? You're gonna pay your taxes, which are real estate taxes in most states, and you're gonna pay for your insurance, right? These are two big things that you need to pay. So let's just say your taxes are, I don't know, $4,000, and your insurance is, let's say, $2,000. So that's $6,000. So if you get the $12,000 minus the $6,000, you've got a $6,000 profit from your rental property. Now this is good because now you've made $6,000. So the IRS says there's a useful life for things. So a home has a 27.5 years lifespan based on the IRS tax code. So what you do is you get your $250,000 home and you divide it by 27.5 years. That'll be around, let's say, $9,000. It's a little over, let's just round it to $9,000. So if I get the 6 minus the 9, I have a negative number of $3,000. That means now I did not make any money on this property and I actually have a loss, which is awesome, right? So here's the cool thing. Did I really have a loss? The answer is no, because I had $6,000 in profit. But the IRS gave me a deduction that I qualified for as a real estate investor of $9,000. So I get to keep the $6,000 tax-free. In fact, I get a $3,000 negative. If you are an active investor, you can actually take that $3,000 loss and apply it to other income, like your W-2. So let's say you had a $100,000 W-2, you can actually apply it to that, and so now you have $97,000 as income instead of 100. And you can do this with any other income. It could be from your business. It could also be other passive income. So you can see the power in depreciation as it applies to an active investor. Now, if you are not active and you're a passive investor in activity in real estate, here's what happens. You get to keep that $3,000 as a little piggy bank, and it can apply either to other rental properties that you have, and you can take a loss. So let's say you had a $3,000 profit in another property. Well, then you would just move it over and it'll go to zero. If you don't have anything else to apply it against, then what happens is you now get to move that to next year. So next year when you file your tax return, you already have a $3,000 deduction on that property. So there is magic there. Now here's where it gets even better. The IRS also allows for something called accelerated depreciation, meaning you can actually, instead of waiting 27.5 years, we can actually make it come faster. And you're probably, how fast, David? How about a lot in year one? Cost segregation is basically getting the home that we purchased for $250,000 and breaking it into little pieces so that we can accelerate the depreciation. So you would count the doors and the windows, or the door handles, the sinks, the tile. All of these can be accelerated in depreciation, and because they can, what you do is with a cost segregation study is you accelerate them on your tax return. So instead of waiting 27.5 years, you can take a lot of deductions with depreciation in the 1, 5, 7, and 15-year window. So if you had the $250,000 home, on average, a cost segregation will be about 25% accelerated depreciation in year one. Now this is really cool because you could take 25% of the $250,000 as a deduction in year one. 25% of $250,000, based on my notes here, is $62,500. So now the $9,000 depreciation deduction that you were going to normally take turns into $62,500. So now, if you take that $6,000 income that you had from the rental property and you take a cost segregation study and you fully depreciate as much as you can in year one, and you have a $62,500 depreciation expense, you will now show a negative loss on your tax return, a phantom loss of $56,500. So why is this important? Remember, if you're an active real estate participant, meaning you actively participate in the activity of real estate investing or management, then you can actually apply that $56,000 to other income. So let's say your $100,000 W-2 minus $56,000, right? Now you're at $44,000 in income. So now you're only taxed on $44,000, not $100,000 like you normally would. You have a home that you have as rental, and you get a $6,000 tax-free check every single year. And the home price today is probably in year 2 and 3 and beyond, every year it's going to be worth more. Maybe in the first year it's $257,000, and the next year it's $267,000, and so on and so forth, that it becomes more valuable, but you only paid $250 for it. Maybe you would increase the rents in a few years. And so all of this working together not only gives you active income or passive income, depending on how you invest in real estate, but also gives you a tax deduction, also gives you tax-free wealth. This is a proven strategy, time-tested, and one of the best strategies for investing in real estate and lowering your taxable income. If you're looking to save taxes every single year, I encourage you, I am begging you, figure out a way to get into real estate. It is the best way to minimize your tax liability, especially if you're a higher income earner, to build wealth and to feel like a badass by not giving your money to the IRS.